International stocks are still doing very well. We talked about this last month. So again, this is one of the reasons why we diversify. Let me fix that so you can't see here. So the US market's up about 10 and a half. International is up strong double digits, anywhere between 20 to 30%. A lot of areas in the Eurozone are shining. It's not listed here, but Spain is doing fantastic this year, up about 50%. A lot of that is due to kind of the composition of those markets. A lot more value stocks are in those countries, and that's been a hotter area for investors this year. So you've seen some good returns there. Our international exposure is doing very well, giving returns 2 to 3 times as much as our U.S. returns. And this is kind of the reason why. So we talked about PE ratio. You can see here in the US, PE ratio 22 times. PE ratio, the rest of the world is only 14 times. Okay. So you can see here, earnings. US has 2.4 trillion of earnings. The rest of the world is 2.1. So the US is still the leader there, but very close behind global stocks. But the valuation is drastically different. 22 versus 14. I mean, that's over 50% higher valuation. So 50% more expensive than these companies globally. So that's what we're seeing. We're seeing a shift. We're seeing investors move to those companies. What are they looking for? They're looking for, pay a lower price for a company that's going to return the same dollar of future cash flow, and that hence give them a higher return if they're going to pay a lower price, right? If you pay a lower price for stock A and then stock B, and they both return $5 of future cash flow, most likely you're going to get a better return on stock A versus B. So that's why we've kind of seen that. So again, these things, it's tough to tell when that happens through time, but it does happen and shift, and we're starting to see that shift